Hey there, everyone. This is Thomas Wood with ValueCharts.com, and I wanted to thank you for taking the time out of your day to join me to learn a little bit about this very cool strategy for trading the S&P E-mini futures contract. Now, this strategy is called a high-low or low-high reversal pattern. It's very simple, and it's very effective on an intraday and end-of-day basis. Now, one of my favorite patterns, it's essentially a two-bar reversal. All right, it's called a high-low or low-high, and you'll understand why it's called that here in just a moment. For a low-high reversal, this is a bullish reversal pattern, so we're looking for the market to go up after this. It occurs when the price bar breaks the low of the previous price bar and then reverses and breaks the high of the previous price bar. So we're looking at the current price bar as it's developing, looking for it to break the low of the previous bar and then reverse and break the high of the previous bar. That's a low-high reversal, and it's suggesting that prices will continue to rise. A high-low reversal is the exact opposite. As opposed to having a bullish pattern, this is a bearish pattern. And what we're looking for is for the current price bar that's developing to break the high of the previous price bar and then reverse and break the low of the previous price bar. This is a bearish pattern, and it's suggesting that prices will continue to go lower. Now, the logic behind this setup is essentially that a market is running the stops before reversing and going its true direction, or its original intended direction. The psychology is that the buyers, for a high-low reversal, the buyers came in and pushed prices all the way up, ran all the stops out of that market, and then turned it right back around and shot it through the floor. And the previous price bar's high or low always is a little bit of support or resistance. So when that's been broken, once that's been broken, we're expecting the market to continue to climb or continue to sell off. And if it reverses, then we're saying, okay, it was around the stops, market's actually reversing, going the opposite direction. Now, when we're looking, this is what a high-low reversal looks like. Again, we have the current price bar, the one that was developing, let's say it was this one right here, breaks the high of the previous price bar. So we came up and broke the high of the previous price bar, and then we reversed and broke the low of the previous price bar. And this is a high-low reversal, suggesting that the market will continue to sell off just like it did here. This right here is what's called the low-high reversal, like we were discussing earlier. It's where you break the low of the previous price bar and then reverse and break the high of the previous price bar, and it suggests that the market will continue to climb because we ran all the stops down below the lowest point, or we broke that support and the market was unable to follow through after breaking those lows. Now, when you're entering this type of trade, you are either getting long just above the previous price bar's high after it has broken the low, or you're getting short just below the previous price bar's low after it has broken the previous price bar's high. So as soon as it breaks the high or the low of the previous bar, then you're looking for it to go and break the opposite. And that's where you can trigger your entry for getting long or short. And then your stop should go above the highest high or below the lowest low of the previous price bar. Now, for those of you that don't know much about the S&P E-mini futures contract and how this works, one, it's a highly leveraged instrument, so be aware of that. You're using a lot of leverage. However, it moves in $12.50 intervals. So it moves in every tick is $12.50. Okay, every point is 4 ticks. All right, the E-mini is one of those markets that has a ton of volume in it, where you're normally not going to have to worry about getting stuck in a position because there's enough liquidity that you can get in and out of the market very easily, especially if you're just a normal trader, if you're not trading a large number, especially just trading one lots. So this is what the S&P E-mini looks like on a 30-minute price chart, and here are a couple high-low reversals and low-high reversals. And this is where you could have taken out over $1,300 in one day just trading one lots. All right, we have a short signal right here because you see that this price bar broke the high of the previous price bar, which was right there, and then reversed and broke the low of the previous price bar. So you would have been entering right here. So you're selling short. Your stop would have been up above the high point. Then you see the S&P continued to fall. You bounced up a little bit, and then here you actually formed another high-low reversal. Broke the high, then reversed and broke the low, suggesting it continues to sell off again, and then it sold off once more. And this move was from around 2095 all the way down to what, 2080. So very, very close to 2080. So you're talking almost 15 points worth of a move there. And then on the upside, after we had reversed and started to bounce back up, we had this very strong up move here. You see on this price bar, we had a low high reversal where we broke the low of the previous price bar. So here's the low. We broke that and then reversed and broke the high. So right here is where you're entering long. And then you can see we followed through for several hours all the way up. And that's a move from about, again, 2095, roughly a little bit before 2095, and went all the way up to 2109. So you're talking 14 points again in the opposite direction. So you had a short and then you had a reversing long in the S&P, and both of them made several over 10 points or over $500 a contract each. If it's about 15 points, you're talking $750 a contract. So this is a really, really good, effective strategy, in my opinion, for trading the S&P E-mini, and you can do it both intraday and end of day. You can watch for this at the end of the day and see, okay, well, today we broke the low of yesterday, then reversed and broke the high, so we're bullish tomorrow. Or we broke the high of yesterday and then reversed and broke the low, so we're bearish tomorrow, type of thing. But I hope you enjoyed this presentation. I hope you learned something. If you ever have any questions, don't forget you can email us at support@valuecharts.com. Now, that being said, if you would like to start a trial, we'd love to have you come in, join us. It's only $7 for an entire month to come join us in the trading room. You can see us trading the markets live in front of you throughout the trading day. We have an options and equities trading room. We also have a futures and Forex trading room. So you can get access to the platinum membership for $7. Just go to valuecharts.com/go. Again, it's a 1-month trial for $7. So look forward to seeing you there. If you ever have any questions, again, don't forget to email support@valuecharts.com. This is Thomas Wood, and I want to thank you for taking the time out of your day to join me. And until next time, happy trading.